Hey Bowtie Nation, Joseph Hogue here with an exciting announcement, a new weekly series we're going to be doing right here on the channel each week, revealing some of the best research in stocks. Now each week I'm going to give you an exclusive look into 3 to 5 of the best articles, the best analysis I've found, kind of a Friday 5 with some great ideas on stocks to watch. I want to get right into this week's stocks to watch, so I'm going to explain more about this in a little bit. This first article, published December 1st, Palantir, this is ridiculous. And, there's a lot of hyperbole there, a little bit of exaggeration. He does make a good case for why the downside is a little bit exaggerated, but we're going to get into that. He actually starts off with that bear case. I actually checked up on this. There are two banks, RBC Capital and Citigroup, lowered their price targets to just $5 a share for shares of Palantir. It's right now at about $7 a share. That would be a 28% downside from that. On top of the stock's already down 80% from its peak and 23% from its 2020 listing. So investors right now are getting a 23% discount just from the listing price when it came out in 2020. Now he goes through the bear case, and it is grounded in some good reasoning, right? That general economic backdrop is negative for enterprise spending. So before companies start laying off people, they generally cut back on some of their other budget items to see if they can avoid laying off too many people. And Palantir has had to cope with that. The big part, though, here is what these companies are talking about. And I don't think anybody is talking about bankruptcy. He goes through a lot of this article saying that people are talking about bankruptcy, and I don't think anybody is talking about bankruptcy for Palantir. It still has positive earnings as well as positive cash flow. There is no existential risks here for this company. But he starts talking about some of the bear case is what Palantir did is this practice of investing in about 20 plus startups, and the terms that the startup would use some of that money to use Palantir software, right? Now this is not unheard of. It is kind of a red flag and a little risky. So basically, they were agreeing to invest in these startup companies, these very new companies, on the condition that that company would then, license Palantir software or use their data, and that would be revenue for Palantir. So a little bit of a you scratch my back, I'll scratch yours kind of thing. And again, it's not unheard of, but you get a lot of these kind of red flags, risky kind of deals. This strikes me a lot of what FTX has been doing with a lot of these other platforms, right? Trying to save these other platforms, coming out talking about how it was going to save BlockFi. Well, when you look into the deal, it was loaning BlockFi, shares its own coin, that FTX, the tokens, so kind of propping up itself while it was saying that it was saving these other platforms. So the problem with these is, of course, that as some of these investment companies, as these small startups go bankrupt in the economic downturn, he gives the example, and he actually has a chart here of some of those. Fast Radius is the one that went bankrupt just recently. Fast Radius signed a $45 million 6-year contract, right? So $45 million in revenue would have gone to Palantir over the 6 years in exchange for that investment in the company. So now Palantir is not only out the revenue, but also out that investment as well. And that's really the risk to this kind of a business strategy. Obviously, it was a strategy very much near and dear to Peter Thiel's heart as a venture capital. He not only wants to run a company, but he wants to invest in startups as well as that venture capitalist. And it came back to bite him in the ass on this one. But you can see there are a lot of other companies where the investment return on those companies is very much, past 90%. And there are definitely going to be some of these companies that do go bankrupt, that do not return that capital to Palantir, and do not go through with those $1 million contracts on revenue for the company. Now, the thing you got to understand here is revenue from those investment companies, all of them, all 20 plus, is only 6% of the total last quarter, right? So the Palantir is expected to report about $1.8 billion in revenue this year, even if every single one of those invested companies went bankrupt and didn't come through with those revenue contracts, then it would still only knock off maybe about $100 million in revenue, which would bite. but it would still bring it down to about 1.75, 1.8, right around there, $1.75 billion for the year. So of course, it probably isn't quite as dire as that $5 price target by RBC or Citigroup, 28% downside for the bear case. The Palantir is currently trading for 7.7 times expected sales and still growing those sales at 20% annually, right? So I do expect that sales growth to come down a little bit as we get into 2023 and the recession there. But, this is the lowest that Palantir has traded, on a price to sales basis since its listing there in 2020. So, we're getting pretty close to a very good value for the shares. I do like the company. I do like its way it's using data analytics, and it's got some great government contracts that are never going to go away, right? The company has an amazing balance sheet, right? This is the one thing that I would probably consider investing in. It's got $2.2 billion in net cash, okay? $2.47 billion in cash, $245 million in debt. So even if you back out all that debt, it's still got $2.2 billion in net cash. So think about this. This is a $15 billion company. That market cap, $15 billion, of which $2.2 billion is in net cash. So about 15% of the market cap of this company, the stock value, is in cash. It's got positive earnings and cash flow. This isn't one of those growth stocks that is so far outside of profitability yet that it's burning through cash. So it is actually going to be accumulating cash. There are no existential risks here. Again, I would like to see it below 7.7 times on that price to sales basis. That's still firmly in growth stock territory. And, my cheap ass doesn't buy anything over 10 times on a price to sales basis. So it is under that point. I would like to see it a little bit lower than 7.7, but I think you can start picking up shares here and hold it for that long term. We've still got 3 more articles to highlight in those 7 stocks to watch. And normally to see these articles, you'd have to have premium access on Seeking Alpha. But join the community here on Let's Talk Money, tap that subscribe button, and I'm going to be highlighting 5 new articles each and every week. If you want to check out more of this analysis, though, I have set up an exclusive deal there with Seeking Alpha for all you out there in the Bowtie Nation. A lot of you know I started writing on Seeking Alpha in 2011. I wrote for years before joining that venture capital firm where I worked at for a period, but I still use that premium access for some of these ideas and analysis that we're talking about. So you use the link I'm going to leave below to try out Seeking Alpha totally free. You get that free trial, and if you decide you like it, you're going to get a 60% discount on that premium access. That is $140 off the lowest price you're going to find online, and in fact it's lower than the price I paid when I signed up for premium access myself. This next article actually published just a couple of days ago, December 6th, titled 3 ridiculously cheap REITs that scream buy buy buy. So I think it's more like ridiculously titled article, but he does make some good points and outlines 3 really good REITs. Before we get into that article, though, I do want to point out this resource by NAREIT. That's the National Association of REITs. They put out this investment performance by property sector and subsector. It's a great big picture look at the different property types within REITs. Which ones you think might rebound, what they're each doing, and we can see that REITs as a total. So these FTSE NAREIT all equity REITs, it is down 21% so far this year, and that's really on those higher rates, economic slowdown fears. Office is down 32%. So office REITs are down 32% for the year. You've got a lot of these. You've got residential is underperforming, 26% down. Then out of some of the winners here, you've got things like specialty REITs are actually up. So those kind of mixed use REITs. You've got lodging and resorts. Obviously, people getting out of their house finally after a couple of years. They want to travel, so they're going to lodges. They're going to the resorts, and those are only down 4% so far this year. So if you look for this on the NAREIT website there, this investment performance by property sector and subsector gives you a really good idea of where the different property types are at and what you might want to invest in. But if we scroll down in this article, he goes through 3 REITs that I want to highlight because they are some good ideas here. He starts off with Global Medical REIT. That's ticker GMRE. It's a 189 property healthcare REIT, mostly office space, but also with some hospital and clinic. Occupancy is 97% here, which across all REITs, occupancy is about 94%. So this is outperforming other REITs of the sector as far as occupancy rates. 6.4 year average lease term, so good long lease terms on GMRE. Now, this stock is down 45% over the last year on tenant bankruptcies, and this is going to be a theme that you're going to see in a lot of these healthcare REITs. We're going to talk about another one that I like a little bit later, but the theme in these healthcare REITs, they own these properties, and then they lease them back to healthcare service providers like hospitals, like doctors, clinics, things like that. And the problem is lately is those tenant bankruptcies. Okay, healthcare providers have been struggling with just a long list of factors so far this year and even into last year. But the biggest one is inflation, right? Not being able to pass on a lot of those costs, and that's primarily because of slow reimbursement increases by insurers and the governments, right? So healthcare mostly paid for by Medicare, the government, insurers, and they're not increasing their reimbursements to keep up with inflation. So healthcare providers are having to eat a lot of those costs due to that. There's also the labor cost increase from the nursing shortage. Okay, my wife is a nurse. I know how big the nursing shortage is right now. So that's just really affecting a lot of these healthcare providers, and of course that is flowing through to to these property REITs, these healthcare REITs, because as those tenants go bankrupt, then they're going back on their leases. Now, one thing this does talk about the valuation in REITs here. The Global Medical REIT is trading for a price to adjusted FFO. Now, that is the price to adjusted funds from operations. And one thing you got to understand here, folks, is we talk about a price to earnings ratio for most stocks. For REITs, you can't do that. REITs own all that property, and they have so much depreciation on their income statement. So every year they depreciate a little bit of those properties off of their income to lower their taxes. Well, that's not really a cash flow expense, right? They're not actually having to pay that, as a deduction on their income statement. So it's kind of a false measure of their earnings. And for that reason, you really can't use price to earnings ratios for REITs, for REIT valuation. What we use instead is called the price to FFO, the price to funds from operations, or the price to adjusted funds from operations. And with any REIT, you're going to be able to find that FFO or the AFFO in their financial reports. They're going to calculate it for you and tell you what it is, so you can calculate that price to FFO. But here for GMRE, that price to FFO or price to AFFO is at 10.4 times, right? So the shares are trading for a price of 10.4 times the adjusted funds from operations, and it's historically about 14 to 15 times. So you are getting a discount of about 30% for shares of GMRE right now. The dividend is at 8.2%, and we're going to see this with that other healthcare REIT that we're going to talk about. Dividends are very high for these just because those stocks have come down so much. The stock prices have come down, but the payout ratio on GMRE, so the Global Medical REIT, payout ratio is 107%. Which of course is not sustainable. A company cannot keep paying out more dividends than it collects in earnings or these funds from operations. So that is a warning sign that this dividend here for GMRE could be cut. It is in danger of being cut because they're paying out more than their earnings. So I would be cautious here for GMRE, but it is trading at a pretty significant discount. Scroll down here. The other one he talks about, Brandywine Realty Trust. This is an office REIT, so they own office properties in Philadelphia and Austin markets. It's down 53% in the last year, and it's really gone nowhere but down for about most of its 35-year history, right? Ever since 2017, it's been going down, which kind of worries me about this one. If a company couldn't make it in those heady years of 2017, 18, 19, when the economy was doing well, if it couldn't do really well in, later 2020, 2021, when we had all that liquidity chasing stocks, if it couldn't do well during those periods, then something is wrong with this stock, okay? They've got a 90% occupancy rate in those office properties there in Philly and Austin. It is well below the industry average. The price to FFO here is just 4.7 times, but there does seem to be a reason for that, right? Anytime you see these exceptionally cheap stocks, you've got to look for the reason and why investors have sold them off so much. And I do think there is a reason these stocks are so cheap. So I'm not so sure that I would follow him into Brandywine Realty Trust here. The next stock he highlights, though, and this is the one I like, this is a Medical Properties Trust, ticker MPW. All you out there in the nation have heard me talk about this stock before. It is also a healthcare REIT, so this is one of the largest owners of healthcare assets in the United States, with 400 hospitals in 32 states as well as internationally. This is a great internationally diversified healthcare REIT for those of you that need that kind of diversification. I like the size and the scale much better here than GMRE. So this is a much larger company. It's going to have much more flexibility, financial flexibility to survive these those tenant problems and those tenant bankruptcies that we're seeing with all these healthcare REITs. Again, this is the same problems with that GMRE that had the industry headwinds, the potential bankruptcy of tenants, but Medical Properties Trust is very well diversified across its tenants, right? No tenant is, I believe, more than about 3 to 5% of its revenue. So, you can still have some of those tenant bankruptcies and not hurt the company too badly. These are still very valuable pieces of property. Healthcare is obviously very much a long-term trend in the United States, and it just has to grow out of the current problems. The price to AFFO for Medical Properties Trust is just 9.2 times. So even cheaper than we saw with ticker GMRE. Okay. So price to adjusted FFO is just 9.2 times, dividend yield of 8.9%. So again, a very high dividend yield. The payout ratio here is only 82% though. So it's quite a bit lower than with GMRE as well. So if we're looking for a medical REIT stock to invest in and talking about the two, I would definitely go with Medical Properties Trust instead. I'm not saying that dividend yield of 8.9% is going to stay there or it's not going to be cut, because the payout ratio is fairly high for this company. It does need to hold some of those earnings back to protect cash flow, but it is still going to be a very good dividend yielding stock, and it's in much better shape, much better condition financially than some of your other healthcare REITs. Our third article here, published by Rita on December 1st. It's his top picks before 2023 begins. He actually highlights MPW, again, Medical Properties Trust, ticker MPW. So we will skip through that one because we just talked about it. Again, it's one of the medical REITs. I own the shares. I think it's a great stock for once the healthcare sector does rebound, over the next couple of years. I think this one will do very well. But he also talks about the RNPs, the Cohen and Steers REIT and preferred and income fund. Now, despite this being called a fund, it is actually a REIT, so it isn't. You're not going to have to pay an expense ratio for that. So I love that. It's ticker RNP. This is actually a 50-50 mix of REIT common shares and preferred shares in financials and utilities, right? And so those preferred shares, those are kind of a hybrid mix between a common stock and a bond, right? They get their dividends guaranteed. They're paid out before common shareholders get their dividends. So it generally means they're a little bit safer, and then they can be converted into common shares at a certain price. No, so you've got a little bit more safety, a little bit higher yield than you'll find with most other stocks, and it's structured as a REIT instead of a fund again. Those preferred shares, though, have gotten hit on those rising rates. Okay, what happens? These preferred shares are very, very high yielding assets, so investors love them for those dividends. But as interest rates rise, then of course investors can buy a bond or some other yielding investment with just as high rates. So it tends to kind of suck the investors out of those preferred shares when interest rates rise, and that's what we've seen this year, right? It's drawing those investors out into the safer yielding assets, but price is fairly stable on this one over the last 5 years. It's a solid 11.9% dividend yield. It's definitely something you want to check out. We've still got one article to talk about, a spinoff that I'm really excited about. But first, I want to personally invite you to get the Weekly Bowtie, our free weekly newsletter with all the stock market news, strategies, and trends you need to know. Each week before the market opens, I'm going to show you what I'm watching in stocks and the stocks that could highlight the week. It's all totally free, just something I like to do for all you out there in the community. So look for that sign up link in the description below. This fourth article here, published December 3rd, about Johnson & Johnson, the upcoming split, time to buy before the split. And Johnson & Johnson has been a great safety stock this year, right? Even on the recent talcum powder legal challenge and the disappointing COVID vaccine. That COVID vaccine didn't do nearly as well as the one made by Pfizer or some of the other companies, but shares are still up 4% this year, so outperforming that 15% loss on the market. So last year, Johnson & Johnson did announce it would spin off its consumer health segment into a whole new company called Kenvue, while its medical devices and pharmaceutical segments would remain in Johnson & Johnson. They gave about 18 to 24 months for the timeline on that. That would put the expected completion right around mid to late 2023. That consumer healthcare segment does account for about 15% of revenue. It brings in about $11.2 billion in sales each year, and it's some great brands. You've got Listerine, you've got Neutrogena, you've got the Band-Aid brand there. And we did recently talk about investing in spinoffs, the spinoff strategy, in a live stream just recently. Spinoff shares have averaged an outperformance of 23% in that first year, 23% over the market return in the first year, and even the parent shares have often outperformed. So what you do here, you invest in the parent company. So you would buy shares of J&J before that spinoff, and then in the spinoff you would get shares of the new company, of that Kinvu, and keep some of the shares of your Johnson & Johnson as well. And again, that research shows that over that first year, then the shares of the spinoff company do tend to outperform the market. And there's a few reasons that we talked about in that live stream, a few reasons for that. One is you got just a closer focus, right? That Kinvu company, they're going to be able to focus just on the healthcare segment instead of having to push all their project ideas up through the bureaucracy of Johnson & Johnson, which is a huge company, and I imagine just a huge bureaucracy trying to get things passed. So they're going to have a closer focus. They're going to have stock options and grants, spurring them on to take risks and grow that company. You've also got what's called a conglomerate discount, right? So you get a lot of these conglomerate companies, these companies with very much disparate segments, like General Electric, which is also spinning off its some of its segments. You've got 3M, you've got Johnson & Johnson here with so many different segments that there is actually a conglomerate discount. So on a price to earnings basis, they trade for less than what they would fetch if each of those segments was a separate business in itself. So what we often see is when those companies are spun off, or when those segments are spun off into a separate company, then you get a higher rating, a higher price to earnings valuation, and a higher share price in the separate companies as opposed to just the one. And again, I really like this idea of buying shares of Johnson & Johnson before that spinoff. First of all, it's one of the few dividend kings, those 48 stocks in the U.S. markets that have 50 plus years in dividend increases. Though it's just a 2.5% yield, that is a very strong history of growth, and you're going to keep on getting the dividends from both segments of those, or both new companies there. The stronger focus on the remaining Johnson & Johnson area of medical devices and pharmaceuticals is probably going to get re-rated higher, right? So those are both very much growth, much more growth sectors or segments than the consumer health, right? Consumer health is going to grow pretty much at population size each year. It's not going to grow very fast. So what you had probably is that's pulling down the valuation, the earnings multiple valuation on those other two segments, right? So when you separate them out and you just get medical devices and pharmaceuticals, which are probably growing sales and earnings at a much faster pace, you're going to get more of a growth stock valuation for that part of Johnson & Johnson. Click on the video to the right for the 5 dividend stocks better than the QYLD. I know there are a lot of QYLD, those NASDAQ covered call ETF fans out there, but these stocks beat it hands down. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.